It's a death of corporate America. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the countdown to collapse has begun as the grim reaper of corporate America signals its arrival as alarm bells sound and bankruptcy surge. Let's over to Wall Street, where we picked today's story up with the headline, "The end of easy money, bankruptcy filings pile up at the fastest rate since 2010. And this is something we could have predicted years ago. During the period of easy money and low interest rates, corporations borrowed massive amounts of money. In many cases, were buying their shares back and giving their executives generous bonuses. And it was only a matter of time before we saw interest rates start to creep up a little bit. But what makes it even worse, as you're about to see, is banks tightening lending standards, making it now near impossible for these companies to refi this debt, forcing them down a path of bankruptcy and eventually default. At the peak of the Fed's yield repression in the mid-2021, double B rated companies, those companies that are junk rated, could borrow around 3%. And companies are junk rated because they have too much debt and inadequate cash flow to service that debt. But one of the problems was there was so much money chasing the market that banks had no problem originating all of this junk debt because investors were buying it no matter what. They knew the cash flow was terrible on these companies, but the yield was so attractive because there were just piles of money sitting around, and it worked. Those double B junk bond yields have now risen to nearly 7%. This means these companies that had trouble producing enough cash flow to service their 3% or 5% debt now have to refinance this debt when it comes due or add new debt at 7%. And that 7% may be low, and historically it is, considering where inflation is running around near that neighborhood, but it puts a lot more strain on these companies at a time when we're seeing demand start to slow down. And of course, that means revenues are going to come down, earnings are going to come down, profits are going to come down, and the ability to service this debt is going to drop. It's going to put these companies in a position, as you're seeing, just the beginning of what is a big wave of corporate bankruptcies that are going to signal the end, of course, as we know, of the corporate America. S&P Global has released its May bankruptcy statistics for companies that are publicly traded with at least $2 million in assets or liabilities listed on their bankruptcy filings, and private companies with publicly traded debt, such as bonds with at least $10 million in assets or liabilities on their bankruptcy filings. In May alone, 54 of these types of companies filed for bankruptcy, and that is a big move higher because during the pandemic, there was so much money being dumped into the economy through fiscal stimulus, and interest rates were suppressed due to monetary stimulus. That banks lent like crazy and companies borrowed a ton of money, and this pushed off what we were seeing as we were heading into the pandemic, what looked like a global slowdown. We were starting to see an uptick in bankruptcies, signaling that, of course, there was just too much debt in a slowing economy. We got it past during the pandemic, and now it's back, but in a much bigger way, because unlike going into the pandemic where the global economy was just slowing at a relatively slow pace, it's now decelerating to the downside. The May filings brought the 5-month total of 286 bankruptcy filings, the most since 2010, more than double the filing for the same period in 2022 at 138. It even outran the 262 filings in the same period in 2020 when some companies faced enormous stress. So now all of a sudden we're seeing a problem occur at a time when policymakers are telling us, look, we're going to see a no landing or maybe a soft landing. And as we see an increase in bankruptcy filings, of course, it also means big problems for the labor market, which we'll get into in a bit. But let's take a look at this chart that Wall Street provided from S&P Global. Here we can see larger corporate bankruptcy filings each year through May, and we know now that this is the end of easy money. Higher interest rates are here, tighter lending standards are here, the yield curve is inverted, everything is a problem, and this is only going to get worse. And the problem today is not the collapse in demand, although I disagree with that, such as it hit some industries in 2020 or during the Great Recession. This economy is marked by rising prices and resilient demand. The problem now is that debt got a lot more expensive, and that investors thinking of buying this debt have gotten a little more prudent. In fact, investors seem to be shying away from high yield debt, pushing rates even higher. But again, this is what I disagree with completely, is there is a decline in demand. We can see this in this next chart here. Even though there's a bit of a bump in demand, I believe that this is very transitory, and we're seeing the early signs of a decline in demand as we head into the summer months. Here we have the current new orders, the diffusion index from the Philly Fed. We love this because it's got a ton of history on it. But one thing we note that new orders is a sign of a decline in demand. So if you see the blue line fall below the horizontal black line, it means demand is falling. Now you might say, well, wait a minute, Steve, we see an increase here. That would suggest that there's demand for new orders. And we did kind of indicate that heading into the summer, as companies needed to restock their summer inventory, there would be a potential increase. But we can note in the past, when we start to see these declines, there is kind of a transitory increase. You see that here in the 1990s. You kind of see a bump here in the dot-com bubble. You see that during the global financial crisis, and then it rolls over and heads down. And of course, are there signs that that will happen? And yes, we'll get to that in a little bit later in the show, that there are signs that demand broadly is going to continue to decline, putting even more stress on these companies that are upside down, have insufficient cash flow, and far too much debt. And this is just the tip of the iceberg, Zero Hedge notes, as commercial mortgage-backed securities storm unfolds, as delinquent office loans now just hit a 5-year high, and something that should also be hitting new highs. This is your trading account. We note that our CTA-Timer Pro, we see it starting today. The NASDAQ is almost pushing kind of new highs over the last 6 months. Many of you said, hey, I missed out on this, but this report would have said, look, this is where you need to start buying. It showed extreme lows. It showed you during this pullback that the machines were buying again, because one thing we do is run a historical overlay on machine positioning to tell you when we're at either extreme long or extreme short. And when this thing's sitting at extreme short, where it was back on January 9th and it was coming out of that short covering, it gave you some early signals to run your screens on this and start taking positions. And then during the pullback on March 15th, it did the same thing, telling you the machines were buying up off that bottom there. And the report, $30 a month, link in the description below. Price will go to 40 for new subscribers soon. I keep getting emails every day. People are telling me this is changing how I'm trading. I'm getting rid of my other reports because this one is so easy to use and so easy to follow. But now let's take a look at these commercial mortgage-backed securities, because this is another problem. It's not just the debt that we're seeing in bankruptcies. What happens when we don't need the office space? You can see it's a double whammy for the banks. The commercial real estate space has experienced stress following the recent turmoil in the regional banking sector, with the rapid rise in interest rates, tightening lending standards, and structural changes such as sliding demand for office building. Some structural factors such as remote work or hybrid work have doomed this space, leaving empty buildings. But according to real estate data from TREP, more than 4% of office loans packed into commercial mortgage-backed securities were delinquent in the last 30 days in May. And get this, the highest level since 2018. Now, if you think back what happened in late 2018, you may not remember this, but the Fed started to cut rates. And why were they cutting rates? Because the yield curve was getting close to inversion. Now today, the Fed says, look, we don't care about the yield curve, but back in 2018, they did, and it helped take the pressure off of this space as rates started to come back down. And here we can see the founder of Popolo Capital Management told Bloomberg that this is just the tip of the iceberg for office delinquencies, as $35 billion in commercial mortgage-backed security office loans are scheduled to mature this year, and the refinancing market is effectively shut to this asset class. And from my own research looking around, people looking to get large loans in this space, they're calling banks, and literally their calls are not being returned. Banks are not in a position to lend against these, which is going to put a lot of these property owners in a position to go into delinquency, then into default, and file bankruptcy. For the banks, it's going to be bad news. And again, we continue to talk about, why is the Fed likely to go back to zero? Well, when all these things start to blow up, the simple answer will be to lower interest rates. And as Goldman pointed out to clients days ago, one major issue is a steep maturity of wall floating and fixed rate commercial mortgage-backed security loans due this year and next. The inability to refinance these in these challenging market conditions will likely unleash a tidal wave of defaults in the second half of this year, again validating our case that the Fed is eventually got to go back to zero. Because when you look at this next slide provided by Goldman, you see these floating rate and fixed rate commercial mortgage-backed securities. There's a mountain of these bankruptcies that are maturing between 2023 and 2024. If these things cannot be refinanced, if these loans cannot be renewed, there's going to be a huge problem. And again, the only reaction, if you think about it, is the Fed going to raise rates in this environment? The answer is absolutely not. And you can just see the death of corporate America forming. Not only are companies going to be filing bankruptcy, the buildings they're in, they're going to go into bankruptcy as well. Investors are going to be in big trouble. And it all comes back to one thing, and that is lending standards. Here we can see the net percentage of domestic banks tightening lending standards for commercial and industrial loans for all size firms against the delinquency rate on commercial real estate loans. So we can look here at, of course, office buildings. And you might say, well, wait a second, Steve. I see here the delinquency rate in the red line. Well, it's pretty low. In fact, it looks relatively historically low. And you're trying to tell me that there's a big increase here and this is a problem? Because right according to this chart, it doesn't look like a problem at all. And that's until you change it to a year-over-year rate of change. And here you can see that on the same delinquency rate, we're going to spin this over to show the year-over-year rate of change. And sure enough, as banks tighten lending standards, where we see the blue line go over the horizontal black line, what do you note? The delinquency rates start to rise, as of course, people who hold these loans cannot renew them or refi them. Again, you see delinquency rates shooting higher here during the global financial crisis. Of course, during the pandemic that happened, but only for a brief period as it came down. And now it's starting to again. And of course, we know the Fed has its head in the sand. I think this is going to get a whole lot worse. But what about you? Do you think this is going to get worse and the Fed's going to go back to zero? Do you think it's not a big deal and the economy can handle higher rates? What do you think? Wait in the comments below, because this is a big problem for the labor market. When you see companies filing bankruptcy and office buildings going to bankruptcy, well, it's not good news for labor. As wage growth is slowing sharply in the U.S. as job postings fall, according to Indeed, advertised wages rose a mere 5.3% in May from a year earlier, a marked decline from the peak of 9.3% in January 2022. The slowdown has been broad-based across industries, but it's been particularly pronounced in low-wage sectors for the type of positions that saw the biggest gains as the economy recovered from the pandemic. At its current rate of deceleration, wage growth would return to its 2019 average of 3.1% late this year or early 2024, according to Indeed. And you can only imagine what that would do to inflation. Of course, if wages aren't continuing to go higher, that means spending doesn't go higher, discretionary spending can't go higher, and inflation starts to cool down. And sure enough, we validate this on this next chart. Here we have the average hourly earnings of production and non-supervisory or rank-and-file employees against the consumer price index, that shown in red, both on a year-over-year rate of change. And while we do not see a perfect representation here, what you can note is as the blue line decelerates, as wage growth falls, inflation cannot stay higher because people can't afford it. And we can note that throughout history here, as the blue line comes down, inflation tends to fall a little bit. It's not in every cycle, but notice, particularly going into recessions, inflation cools off only because wages are falling. And here we see wages coming down, inflation coming down. And I know many people say inflation is going to stay hot. Well, if people cannot afford to buy stuff, there's no way it can stay elevated. And particularly so if people are losing their jobs. As U.S. jobless claims surged to 261,000 now on the weekly basis, breaking that mythical barrier of 250,000 that I've been calling for. This is the highest since October 2021, and initial jobless claims rose by 28,000 to 261 in the week ending June 3rd, which includes the Memorial Day holiday. Continuing claims, which includes people who have received unemployment benefits for a week or more and are a good indicator of how hard it is for people to find work after losing their jobs, did fall from 1.8 million now to 1.76 million. That is the lowest level since mid-February. So perhaps some sort of indicator that people are getting back to work as other people are losing their job. But what does this mean? Are more people likely to hit the unemployment line? Well, they are, and I'll show you in the next chart. But keep in mind, the reason demand falls as people go on unemployment is because their wage falls significantly. Here we can see average hourly earnings of production and non-supervisory employees, this again in blue, against the 4-week moving average initial claims. And no surprise, as wage growth slows during, of course, periods where you head into a recession, what does that coincide with? It means people are losing their jobs, and that is because employers still need to give the employees they want wage increases, but they don't have to give them as big of ones because they're busy laying off their counterparts. Here we can see that happening again right now. And also we note that, of course, during periods of tightening lending standards, we can see that as banks tighten up lending standards, the creation of new money goes down in the economy. That means there's less money to support the economy, and in turn, an increase in the 4-week moving average initial claims, suggesting that even though at the moment we may not see a big increase in layoffs, it's only a matter of time before it gets here. And maybe perhaps we'll get a kind of a pause for the summer as employers look to stack up employees. But when demand falls, you'll watch, everybody is going to be fearing a pink slip. And now we know how this is the beginning phases of the death of corporate America. We're seeing it in the bankruptcy filings. We're also seeing it in the lending standards. The last shoe to drop is the unemployment claims. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.